So I do just a basic, easy calculation. Okay, what's the fundamental value? What's the true value of an ounce of gold for its most important function? And in my opinion, the most important function is to hold your wealth, your purchasing power even. Does many other things,
sure,
but that's the most important function. So if I know for an absolute fact that the true value of an ounce of gold is $50,000, then quite honestly, I haven't really spent 50,000 on a coin, but I'm just saying, I do know that the minimum fundamental value of an ounce of gold is 50 grand. So if I spend anything less than that, and it's on even a high collectible, my bet is hedged.
You described Bitcoin and cryptocurrencies as almost like an ideal training ground for, so why would the US government allow, such freedom of owning cryptocurrencies competitive to the US dollar? Well, because this is an ideal training ground to train the public to become accustomed to a digital currency so that when they roll out their government issued digital currency, we already understand how they function. Whereas if we were just hit with this cold turkey, moving from paper money to a government issued digital currency, we'd all be like, well, I don't understand this. What is this garbage, right? Like, I don't.
Here's change. Oh yes. My goodness. Because one thing they knew, and then you did it great. One thing they knew when they set up this whole system is that, people marry the legal money of the state. And so what they say in their documents, so I'm not making this up, this is what they say in their documents, anybody can read them, is that they need to keep the new currency as close to the norm that people are used to as possible. And that's what happened in 1971, right? And if you look at the bills, they look really identical. It's very subtle. So people did not know of the change. Now, I think it's coincidental that in 1996, the NSA did a white paper, government agency, did a white paper on how to create a mint, outlining how to develop the cryptocurrencies and the market. Then in 90, I think it was 7 or 8, there was a peer review paper on smart contracts. Bitcoin came out in January of 2000, and I've been watching it since it was $7. One of my clients said, hey, look at this. So Bitcoin came out in January of 2009. What else? Where were we in this trend cycle? The system died in 2008. Hello, it died, right? And then in March of 2009, the Federal Reserve began this next major experiment in quantitative easing, which is just massive money printing to massively devalue the currency. Is that a coincidence? I don't really believe in coincidences, if you want to know the truth. So yeah, that is my opinion of it. And I will say the people that buy the cryptocurrencies and the people that buy the gold have a very similar mindset. They're really unhappy with what they're seeing, and they want a decentralized private place to hold wealth. I get that, and I really do get that. But I don't think you're very private with Bitcoin, because what do? When you open an account, don't you have to give them your name, address, social security number? And they were supposed to not be able to, on the blockchain, that was supposed to be a permanent transaction. And yet recently, haven't we seen some money being clawed back by the government in Bitcoin from people that had taken it? So that means that's not really true, right? It's not immutable. They can claw it back. So it's not private. It is decentralized, except that it has to go over computer systems. And the IMF did a piece, it was like 2017, AC chain tied. This is a new, bear with me here. I'm going back in my memory here for a second.
Yeah.
But they came out with a new cryptocurrency, and their currency was tied to Bitcoin and then went through these nodes. And one of the nodes was that it went through the IMF. Now, in another paper, and it converted into an SDR. right? So when it was matched with their coin was matched with Ethereum or Bitcoin, then it turned into an SDR, and it went through the IMF node. Now, they had a paper on the IMF had a paper on how every title to every asset would be held in digital form. And then it would be broken down into itty bitty pieces. And if you're holding all of your data and all of your wealth on a phone, which makes it super easy to spend, and you are inspired to buy that boat, and you have equity in your house on your flipping phone, that will inspire you to spend your equity. And before you know it, you will own nothing and you will be happy.
We need something that is a neutral reserve asset, because I think the way Keynes described it during Bretton Woods, and I've heard the IMF say that several times. So I guess it's about the world moving to a neutral reserve asset that isn't controlled by any country, and you think that's going to be gold. So I think that's your end game. Can you go ahead and maybe give us your version of that?
Yeah, I think at least in the intervening term, it's gold. I mean, it could. There's no reason it couldn't also be Bitcoin, something like Bitcoin. But that's right now, gold's on central bank balance sheets. Bitcoin isn't. So we'll see how that develops. But I think when you look at the combination, the fundamental problem is that in order, peak cheap energy combined with the sovereign balance sheets of the world, in particular of the West, and in particular the reserve currency issuer US, means that in order to keep treasury bonds, and we'll pick on treasuries because it's the reserve currency issuer, Europe has some similar problems, but to keep treasury bonds nominally AAA rated, you can't by definition keep them AAA rated on a real basis, particularly in oil terms, right? So basically, peak cheap energy means it's getting more and more expensive to grow and find the marginal oil barrel. That's likely to continue. And while there are some alternative energy things we can do, the fact of the matter is oil and gas are still, 70–80% of our global energy consumption. And that's not going to change in a time horizon that I think is relevant for this discussion. So oil is going to keep getting more expensive if you take out sort of, cyclical moves, right? So oil is going to rise, which means treasury bonds, particularly with rates at 0 or 25 basis points after today, I suppose, are going to lose value against oil just on the geology of oil alone.
Right.
Then when you take into account the sovereign balance sheets of the West, the US specifically, you have the situation where they can't afford to let rates rise very much to compensate you for the rising energy costs. And so they're going to have to basically at some point grow their balance sheet to, they have to keep real rates significantly negative. And we've seen that. And you and I talked a year ago, and I said, look, I think real rates are going to at least -5, maybe -10 or 15. And people at the time were kind of laughing. And of course, they're not laughing now. Here we are, -8. So it's this fundamental problem where to get the West out of the problem they are with their debt load, particularly in the context of a peak cheap energy world, you've got to have significantly negative real rates, but that, and particularly in energy terms, but that doesn't work if you're a creditor. That means basically you have an ice cube of savings that's melting away at 8 to 10% per year in energy terms, which really matters because if you don't have enough energy, you're going to starve, economy collapse, a whole slew of bad things that political leaders will do.
Luke, why don't you give an example of a country that would be applicable to? Because I think that'll help the listener kind of get their mind around what you're saying. So if you're a country, I think the way you termed it with Grant is if you're long dollars and short energy, then
you're China.
You're holding onto those dollars in treasuries. And if the treasuries have a negative real yield, then your purchasing power or how many barrels of oil you can buy with those treasuries is decreasing. And that's bad news if you're a Japan or a China.
Japan, China, Europe.
Yeah.
And quite frankly, it's bad news for Russia too, right? You sell a bunch of oil today at 100, and then in 10 years it's 400. You would have been better off just leaving it in the ground, because you're not going to get compensated with interest with rates at zero, and the U.S. can't let rates rise enough to do that. So that is both sides of the coin. It doesn't work for anybody. It doesn't work for the U.S. middle class or working class. It only works for sort of this narrow set of interests that are closest to the dollar system. So I think what we're seeing is the system feeling itself out, the different players trying to enforce their desire to move to a system with a neutral reserve asset, right? Because at the end of the day, gold is just a 0% yielding bond, right? Okay, so Treasury is 0% yielding bond, gold is 0% yielding bond. Gold is infinite duration, Treasury is finite duration. Gold is finite issuance, Treasuries are infinite issuance. And gold has an infinite face value, and Treasury has a finite face value. And you could use apply some of these same things to Bitcoin, and it's even more attractive, I think, on the issuance side than gold is. But the point is that in the situation where we are with energy, with sovereign debt where it is, you need to move to a system with a neutral reserve asset. And if you don't do that, volatility is going to rise, and the system's going to you're going to increasingly see commodity producers decide, I'm just going to leave it in the ground. I would rather have oil than treasuries, so I'll just leave it in the ground. I'll take out what I have to take out and to pay my dollar debt, and anything else I'm going to leave in the ground, and the system will break down.
One point that I would make is that when you say this is the highest inflation since 1982, 40 years basically, that's true. But the inflation in 1982 that we're comparing it to was the end of the inflation. It started really in a severe form around 1976. And so by 1982, it had come down to 7.5% or thereabouts. So you're right about those numbers. But it was up to 15% in 1980. So 7.9 or whatever the last number was in terms of the monthly inflation figures, yeah, that's pretty bad. But don't think it can't go a lot higher. It can. What I expected, and I still expect this. Let me put it this way: I still expect this, but I pushed out the time horizon because a lot has happened and we have more data. There are two kinds of inflation. And one is what they call cost push inflation. The other one is demand pull inflation. Those are economic jargon. But demand pull is when it's driven by the consumers, the everyday American or everyday person around the world. They see some inflation. They go ask the boss for a raise. They go, hey, I need more money to keep up. They accelerate purchases, like, oh, gee, if that refrigerator is going to be more expensive 3 months from now, maybe I better buy it today before the price goes up. It kind of feeds on itself, but it's very much driven by consumer behavior, the behavior of labor and working people, trying to keep ahead of something that they're living through. So that's demand pull. The other kind of inflation is called cost push. That comes from the supply side. That basically is, an oil embargo or a war in Ukraine or economic sanctions or supply chain disruption. There could be a lot of causes or multiple causes, but basically it's not that the consumer has so much changed his or her perspective, but they can't get stuff, or the suppliers are raising the prices because, hey, our input prices are higher, so we have to raise the prices to consumers. Now you can have both. One can feed. It can start as sort of cost push, meaning it starts with supply chain disruption, comes from the supply side, but then the consumers say, "Hey, no mas, enough. I want to raise," and so it can feed on itself. The reason I make that distinction is because the Fed can possibly do something about the demand side. The Fed can, squash it by raising interest rates and raising mortgage rates and deflating asset values, et cetera. The Fed can't do anything about oil. The Fed can't do anything about the supply side. They maybe people think they can, but they can't. And that was what we saw. That was how it started in the 1970s. It started with the Arab oil embargo, which went through two separate phases, one with the Arab-Israeli war and then later with Iran. We had two separate, periods of spiking gas prices and gas lines in 1974, again in 1979. But that started from a supply side that the Fed couldn't do anything about, although the Fed probably was too easy at the start of it. So right now, this inflation has come from the supply side. Now, how will it play out on the demand side? That's the question.
That's interesting, because I had one professor of applied economics on saying, look, this inflation has nothing to do with broken supply chains, et cetera. It solely has to do with money supply and the surplus of it. So would you say not so to that?
Was that Professor Hankey or?
Yes.
Yeah, I know Steve. I have two degrees from Johns Hopkins, so he's very much a. Steve is brilliant, great on foreign currency, great on currency boards, and a lot of other things. I completely disagree with that description, and I'll tell you why. And I've said this before. The Fed has exploded the money supply, so there's no question about that. M0 has gone up by 400%. The Fed's trying to rein it in a little bit, but when you go from 800 billion in 2008 to 4.3 trillion in 2013 when they started the taper, to 7 or 8 trillion, which is where it was after the pandemic in the spring of 2020, there's no question about the money printing. But that money doesn't go anywhere. It doesn't do anything. It's basically the Fed expands M0 by buying bonds from the banks. They take the bonds on the portfolio. They give the money to the banks. Money comes out of thin air, but the banks just give it back to the Fed as a deposit in the form of excess reserves. So you're inflating the liability side, which are the excess reserves, and the asset side, which are the bonds. You've inflated your balance sheet. You've increased M0, but you haven't done one thing for the economy. There's nothing about what I just described that goes into the real economy. Now, where does money for the real economy come from? It comes from commercial banks lending and consumers spending, and that shows up in velocity. And if you look at the velocity statistics, they've crashed in the last 10 years and they're still going down. So the reason so-called money printing doesn't turn into inflation is because the money doesn't go anywhere.